Welcome to Her Wealth Unscripted. We're your hosts, Susan Jones
and Sara Gelsheimer. We believe financial decisions are most powerful when they're made with intention and grounded in what matters most to you.
This is a space for real conversations about money, life, and the moments that change everything.
Because it's more than numbers, it's the life they make possible.
And I think a lot of people don't realize that you can invest a donor advised fund. Mm-hmm. And so if you have a large donor advised fund, you can invest it in equities or bonds or whatever you want combination. And that can grow tax free, and then it can go out to the charities eventually tax free as well.
Yeah. So. And in your example earlier, you can list the kids to actually be the ones who get to dictate those grants at death if you decide you want them to make those decisions at your death versus making the decisions now on the in charity. So really is a great opportunity for that to grow. And then it can be the kids' philanthropy bucket, for them down the road.
Yeah, later on. Another way that people can make gifts is using their qualified plan, so their IRA. And I think this is something, I used to be a little bit less, I don't know. I thought it was a great idea, but until this past summer when the One Big Beautiful Bill Act, the OBBBA, was passed, I thought for a lot of taxpayers, it was a little bit of a break even. And so the way it works is that you can gift up to, I think it's $107,000 right now. It was $100,000 for years and years. And then just recently it was became indexed for inflation. And so it's a little over $100,000. But the way it works is that you can give that amount directly from your IRA as long as you're age 70 and a half. And so even if that is younger than your RMD age, you can actually still go ahead and do that as long as you're 70 and a half. And that and a half is important. So just, I did have a client one time who just couldn't wait until that day. And so we all had it calendared that was the day he could start giving from his IRA. But you can make it a gift directly to charity. And although you don't get a tax deduction for it, it does get, it's not included in your income. So, prior to the OBBBA was a little bit of a wash for a lot of taxpayers because although you didn't have the deduction, you also didn't have the income. Whereas if you took the income, then you could theoretically get a deduction, and they would oftentimes, wipe each other out in a way that really wasn't too impactful. But starting in 2026, so this year, because of that tax legislation, there's now a 0.5% AGI limitation on charitable gifts. So when you make a gift to charity, the only piece that's deductible is the amount that is over that 0.5% of your AGI. So if you have a large income year, that obviously is a much larger number. And so now making gifts directly from your IRA can be really helpful. There's also, again, because of that law that was passed this past summer, overall limitation on itemized deductions. So if you're in the 37% tax bracket, the highest marginal rate that you can get a benefit from is 35%. Mm-hmm. So just overall, there's these new limitations on itemized deductions, which of course impact charitable giving. So I'm now a bigger believer than ever in the ability to go ahead and, especially you have a large IRA, you have a large RMD. A lot of our clients, they really don't want or need that RMD for their living expenses. And so it can be a great way to fulfill your charitable giving intention.
Yeah, I would say the vast majority of my clients who are of required minimum distribution age, so that's 73 to 75, depending on when you were born, the vast majority use qualified charitable distributions to offset that RMD, which is, it's such a great benefit. And even more so now that there are some more limitations with the standard deduction, with the OBBBA.
Yeah.
And so what I've seen a lot of clients do, let's say that they retired at age 65. And so what we'll do is we'll figure out, okay, if their annual giving is $20,000 a year, we'll determine, okay, if you retire at 65 and your income's going to be lower, let's do a big donation to a donor advised fund and get you all the way to age 70 and a half, or maybe even 73 if you want to wait till you start your RMDs, and really fund that donor advised fund for that number of years, and then deplete the donor advised fund so that at 70 and a half or 73, that's when you start making those gifts from your IRA. So there's a lot of cool tax planning with both vehicles, depending on when you retire and your income of each year.
Yeah, that's a great point. And one of the things for a traditional IRA, one of the reasons that our clients don't love them is because it comes out as ordinary income. So from a tax impact, that's kind of the worst, right? So we like our qualified dividends and our long-term capital gains, and then ordinary income is sort of the the one that you want to put last.
Yes.
And that is also true of the after death. And so for inheriting an asset, because their taxable investment portfolio is going to receive a step up in basis at death, their family members are likely going to inherit that without any capital gains, as opposed to an IRA, which continues to be ordinary income for everyone who inherits it later on. And so for a lot of my clients, not only do we plan to do those charitable distributions during life, but then we actually name a charity as the beneficiary of the IRA. And I think also a lot of people don't understand is that you can divide up your IRA into as many different IRAs as you want to. And as far as the IRS is concerned, it gets aggregated. So it's still just one IRA. But in terms of being able to name charitable beneficiaries versus trust versus family members, you can do that in a way that you can make sure that the charity gets the amount that you want them to. So you can really kind of go ahead and say, this is the pot of money that I would like to go to charity, start making those qualified charitable distributions during life, and then actually name the charity as the beneficiary at death.